Hey, good morning, everyone. Marty Mazzora here. It is the 28th of September, 2025, with an update for you on markets, on the economy as well. At least we'll touch on some data. And I want to start, though, with the screen in front of you, which is an exchange-traded fund that tracks what are called business development companies. Now, these are companies that provide financing for companies that can't get it by traditional channels, debt financing largely, and some equity financing as well. So I probably haven't shown you this since late 2019 and probably throughout 2020 as well. So I really kind of view this as a financial stress indicator, although it's not in our financial stress index, but it is something, as I suggested, that I will look at when I think it could be giving us important signals. The idea here is that this fund does well when the environment for small businesses, growth, innovation, whatever they bring is good, and that those companies are able to satisfy their obligations. Those obligations being to the companies that find themselves in this particular ETF. And as you can see, since the summer, this particular ETF has rolled over pretty hard, and more so of late. So the signal there is one of concern about a not small cross-section of U.S. companies. I mean, small businesses employ better than half of the U.S. workforce. Let's just take a look at it back to its inception back in 2013. And see if it offers us any insight as to where the broader market, in this case the S&P 500, might be going. As you can see, 2014, we were entering what I was calling then a mid-cycle slowdown in the economy. We didn't get to a recession, but we did see the stock market from here to here give up about 16% of its value. And as you can see, as the market was continuing to meander into all-time high territory, this thing then was beginning to roll over pretty hard. As you can see here, it started rolling over in 2017, which was a wonderful year for the U.S. market. So really wasn't a concern until the market struggled a little bit here in 2018. We had some volatility-related blow-ups in the ETF space, and they called this Volmageddon, if you will, but it was about a 10-11% decline in the S&P 500. What was much bigger was this 20% hit that it took in the fourth quarter of 2018, and you could see that this ETF had already been rolling over for quite some time. Right here before COVID, you could see that it was topping out before the market rolled over 35+%. Right before the almost 30% decline in 2022, you can see that this thing was topping out and was not able to pound into new all-time highs as the S&P was. And then we had that correction in here. And then of late, pretty dramatic move. We had this year's 21% correction, we'll call it, more than that in this ETF, but it came up and didn't come anywhere near its recent high. So that's something to look at. Again, I don't know that we should take it too seriously here. I think it's more of a financial stress indicator, economic indicator, if you will. But sure, certainly if it is giving us a signal about the state of the economy, it's the kind of state that would inspire the Fed to more aggressively cut interest rates, and that at least initially might be good for the market. But if it means that ultimately a recession may be coming, that is the makings for the next bear market, as we've talked about a lot. So not forecasting that necessarily anytime soon. Our index that tracks the economy is in the red slightly, which says we need to not ignore that risk right here. Okay, so I am going to jump around quite a bit this morning. I've got the consumer confidence data. On Friday, we got the latest from the University of Michigan. It is a mess. Interesting to look at the details, though. Folks who have stocks are feeling pretty good about their lots. Folks who don't aren't. Folks in the upper half of the income distribution are still feeling pretty good, and they are doing virtually all of the heavy lifting, and they have for quite some time on consumption in the economy. If the markets begin to crack, I think we're going to see those people begin to cut back. So, state of the consumer, at least from a sentiment standpoint, is not looking too good. What's really broken down is that correlation between the stock market and consumer sentiment. I've shown you over the years how consumer sentiment pretty much follows the market. Well, in what's called the K-shaped economy, right, where you have the folks who are doing well and then the folks who aren't, there's enough people who aren't, that are being asked for their feelings about their financial situations, who are really pulling on these indexes and destroying that old correlation between that. So unique times we live in, late cycle for sure, late cycle dynamics, particularly in a market that's been very financialized like the U.S. So more to come on that, no doubt, as things continue to unfold. Okay, what else do I have up for you here? Initial jobless claims actually fell dramatically here this last week. 2 weeks in a row, they've come down. We had an anomaly 3 weeks ago that got corrected last week and then a further drop this week. This also happened on the day where GDP was actually revised higher. And what have I been saying? Look out for strong economic data because that probably isn't going to be welcomed by markets. And sure enough, the stock market had a rough day on Thursday when both of those indicators came out. Why would that be bad news for stocks? Because stocks right now, at least the narrative is that the Fed is going to continue to keep this market bulled up into all-time high territory by lowering rates, maybe aggressively going forward. Categorically, folks, they will not if the economy doesn't continue to show weakness going forward. And if they don't, the market's going to lose at least that narrative. And if the powers that be continue to throw stimulus at every hiccup in the economy before we actually can get to some real contraction, well, then that's just going to keep inflation alive. And at these valuations, inflation and the stubbornly high interest rates that go with them are not good news for the market. So right now the market's begging for weak data, but you got to be careful what you ask for because when you get these recessions, which are these red shaded areas, that's when you have problems in the markets. Okay, I did notice that heavy truck sales continues to roll off a cliff. Heavy truck sales are not a bad indicator about the economy. You can see how they tend to look heading into recession. We had a mid-cycle slowdown here. We didn't quite get to recession, but you can see the weakness. So we'll see. We'll see how that plays out. However, truck tonnage actually spiked upward a little bit. So the actual volume wasn't bad, and it was better than the previous month. So that's a positive sign that counters what I just showed you. However, the go-to, which is the CAS data, says shipments are rolling over as are expenditures. Not a great sign, as you might imagine, about the state of the U.S. economy. However, the economic surprise index in the U.S. has spiked higher into positive territory. That's last Thursday. That's the lower jobless claims and the better GDP. And again, that was, as I just told you, was somewhat problematic for the market that day. Okay, so, we spent a lot of time on the dollar last week. I showed you how the whole world is bearish the dollar. Makes me a little bit concerned because our portfolio is tilted toward a weakening dollar, which is why we've had such a good year so far this year because the dollar's been so weak. Our long-term thesis is very solidly a weaker dollar thesis, although I said along the way, we could see some spikes, particularly when everybody is on the bear side of the boat with regard to the dollar. So you can see since we had that conversation, we had a couple of big days in the dollar, although Friday came off and the market did rally as yields came off a little bit on Friday. And that was on the Fed's supposedly favored inflation indicator coming in right at expectations, maybe a tenth weaker than expectations, still like 2.9%, call it 3% inflation against the Fed's 2% target. But the market was thankful, I guess, that it wasn't hotter and that the Fed may continue to cut interest rates this year. And you can see the impact on the 10-year Treasury, which, by the way, reflects in mortgage rates. So here's the Fed cutting interest rates, and here's the 10-year yield, moving higher. I think if they cut 50 basis points like they did September 2024, I think the markets would have been a mess on that news. We need to see more weaker data, and we need to see the long end continue to roll over. And that would be, for example, the longer end here, at least the 10-year coming down. before the Fed really should get aggressive cutting interest rates. It was last week or so that I showed you the Russell 2000 breaking out above all-time highs set way back in 2021. But I did say, look out below if it's another failed breakout. Nothing worse than a failed breakout like the one we had here in 2024. So unfortunately, the last couple of days, it looks like that breakout may be beginning to fail. I wouldn't say that yet. But it's coming back and testing this right here. So this is either going to be support for a sustained trend higher, or it's going to be resistance, and could get pretty ugly. We did add some small caps just to give us more oomph if indeed we get that soft landing that so many people and the market seems to be counting on because of the relative attractiveness relative to large caps. Again, they haven't seen it this high since 2021, but we're not going there as large as we would at the beginning of an expansion because we could see this fail right here. The S&P 500 versus the S&P 500 advanced decline line, a breadth reading. Here we are all-time highs, but the up versus down volume is not confirming these highs. It says that there's some consolidation, maybe some more selling of these rallies right in here. The scariest breadth chart I have is a NASDAQ composite advanced decline line. We haven't seen anything like this since before an 80% decline when the tech bubble burst. I'm not forecasting that, by the way. I'm just telling you that this is a concerning look. And then lastly, with regard to breadth, is the S&P versus the numbers of S&P 500 stocks, or the members in that index that are trading above their 50-day moving average is 56%, while the S&P is substantially above its 50-day moving average. So only about half are playing that game, if you will. And you can see historically not a bad slow-moving indicator of weakness. Before these dips, you can see the bearish trends, and before the rallies, you can see the bullish, the higher lows that we pointed in here. Remember, right in here, we were all over this one, and I said, listen, looks like this thing is bottoming out, at least based on this indicator, as we have a bullish divergence against a lower low. So here we are with a pretty concerning look about the next few months for the S&P. The 1-year daily chart that I show you, you can see we've broken out of that rising wedge pattern. That would be a sell signal for technicians, for traders. You can see we had a gap. We filled that gap. We'll see what happens next week. Could get good news and just keep meandering our way higher. Right now, we still have those long bearish divergences, which I've shown you over the years, ultimately tend to lead to something worse than we've seen to the downside. And just a brand new little sell signal here on the MACD. The gold chart, or GLD, the ETF that tracks it, continues to be very stubborn against a very concerning technical picture, as I've illustrated for you here. We are concerned in the short run. We're hedging our position, but we are still bulls for gold in the long run. So folks, that's all the charts I had loaded up for you today. I think that's enough for one day. So much going on. I will continue to keep you updated and hopefully give you interesting and pertinent topics. But most importantly for clients, just want you to know what we're thinking and why you're seeing what you're seeing in your portfolios as we continue to adjust, at least at the margin, and continuing to hedge where we think we are most at risk. But it's been a good year so far this year, thanks to our allocation, thanks to the lower dollar. We'll keep doing our job day in and day out and reporting to you as we go. Thank you as always for watching and listening, and hope you have a great rest of your weekend. Bye-bye.